Ladies and gentlemen, welcome back to Institutional Sundays, the best 10 minutes you are ever going to spend as a trader, at least this week, okay, to get you set up. We're going to get you set up for the week. I'm going to show you what I'm looking at for the week ahead in terms of sentiment, risk going in, no liquidity gaps, traps, and all the other nonsense I hear people talking about. Okay, markets are more complex than that, and this is a really good place to start, but we'll only be doing it for 10 minutes. Okay, so those of you that are here, congratulations, tick in the box. Okay, you're obviously serious about this and not here to mess about like all the other videos I see on here. So anyway, here goes. Year-to-date performance. Okay, really important to look at what the markets have been doing up until this point, because it will have a bearing going forward. Obviously, major institutional investors will be thinking about this into the week ahead. It will be a factor, obviously probably not the biggest factor, but a factor. Last week will definitely be quite a big factor. What happened last week, are we likely to see that continue into this week? The week ahead, which is why you are here. Obviously, we want to talk about what is likely to happen in the week ahead. To do that, we need to start forming a picture on the main items in what I think will be in question for institutional investors anyway, and that's all I care about because they have all the money. And then I'll even give you a forecast, all right? So let's just get into it. Okay, so I mentioned we'd start with year to date. Obviously, no denying the market has been very strong this year, almost up 15%. Did have quite a deep correction due to the tariff war, I guess you could call it, and continuing uncertainty around rates. You know, what the Fed going to continue with restrictive rates? Was it going to start an easing cycle? We didn't know. Once both of these things dissipated, we've had a huge rally, right? Massive rally since then, and we're now up 15%. So that's a positive, essentially. That's obviously gives a lot of confidence to investors, not only going into the next week, but going into the rest of the year. Okay, so market very strong and likely to finish the year very strong, at least around these levels, is my opinion. And part of that will be because of what's happened so far, and obviously we'll dig deeper into that by looking at what happened last week. Now last week, we can see we actually had the opposite of what I've just shown you there. We actually had somewhat of a sell-off, but we can look behind some of the factors of that. Okay, it seemed to be fears around AI, which I'm going to show you, I think really was just an excuse. Okay, I don't think there's anything in the AI story that suggests we have a bubble at the moment. I think that this was just profit taking. All right, we're up a lot. We're at the highs, which you can actually see here. If you look here, we're only, what is it, about 2.35% off the highs. Okay, so market is very toppy. So is it any surprise market wants to take profits? No, we're nowhere near correction territory. You know, like industry wide accepted definition of a correction, 10%, like what we saw, and even more. You know, what we saw at the early part of the year. We had quite a big correction, didn't we? But we're nowhere near it. That's the point. So, you know, no surprise that the market wants to take profit. So I think generally these are all very positive factors. If we look at what's been happening year to date, even what happened last week, we had a very minor correction. Okay, so relatively speaking, we're still 2% off the high. So all very supportive factors going forward. Now it's important that we do keep forward looking in these things, but to do that, we obviously need to look at more than just what's going on the charts. We need to look at the factors driving some of that long-term and short-term performance. If you're like me, a day trader, obviously these things to an extent will have an effect on the general underlying feeling for the whole week, the whole upcoming week. So to do that, we really need to take a step back and look at what is the Fed thinking, because obviously what the Fed is thinking is ultimately what the whole market is trying to understand. So then they can reflect that in their own position taking. So Fed is really driven by two factors, jobs and inflation. We're going to start with inflation. Again, we'll keep it under 10 minutes, the whole thing, all right? So be quick. The other important factor driving the markets are earnings, which we'll have a look at very not only the S&P 500, all markets, because obviously earnings will have a big impact on every asset class, in the sense that other asset classes are heavily correlated with equity markets. Okay, so if earnings are strong, suggests a strong economy, which suggests strong asset performance throughout. So it doesn't matter what you're trading. Geopolitical news we're going to skip this week, just because it has died down a little bit. Okay, it's not as upfront in investors' minds as it was at the start of the year. So let's just start with the Fed and inflation. So what we have here, what I like to look at is I like to look at rates, so US rates, which did get cut minus 25 basis points to 3.75 to 4% target range. So let's just call that 4% there. We saw a cut from the peak. I think they're off around 1.5% off the peak. So what's that? That was 1.5% off the peak. Okay, so this was 5.5%. We're now down at 4% at the top end of the target range, the Fed funds target range. And I like to look at that versus inflation. Okay, very important to look at the two things together. If we look at inflation right now, we're at, I believe the latest reading was 3%, which I do like to track myself. We had a little bit of a late release because of the government shutdown, so 3%. So it is starting to creep a little bit higher. So I think this is something we need to watch for. Okay, inflation at 3%. At the moment, rates are quite restrictive, which is good. Okay, because inflation is, rates are above inflation, which should at least act as some sort of a stabilizer on inflation. So I think it's important that the Fed don't cut too quickly. They've done that in the past. They've made that mistake. You know, we see it over here, and then suddenly inflation spikes. And really, to keep it restrictive, I think they want to keep these things rates above. So this will be a key factor. But for now, the fact that inflation is rising but the Fed is still cutting suggests to me that this isn't something they're looking at right now as a primary factor. They seem to be quite comfortable with inflation struggling to really, did start to head down, didn't it, towards the kind of 2% target, but seems to be struggling to do that at the moment. So I think it's something to keep an eye on, although, you know, it seems to be relatively safe in terms of the gap between where rates are and inflation is at the moment. But I don't think it's something they're looking at the moment. I say that because I personally think they are targeting, or at least looking more at the job situation. Obviously, they are mandated legally to keep employment stable within the economy, and you can see the number of jobs being added, right? It actually has been softening, is probably the right word. It's not dramatic, you know, we haven't seen anything crazy going negative like we did during COVID 2020. It's just been softening a bit, and I think that's given them the confidence to cut rates. So I think as long as we stay around these levels, it's going to continue to suggest to the market that the Fed will be comfortable cutting. Okay, and therefore I think in a paradoxical way, a softer jobs market is actually very supportive for the equity market, right? Which is what we're seeing. We're seeing that. And one thing to really keep in mind is, because of the government shutdown, we haven't really had payrolls data, I think, for 2 months now. But they've been looking at private data, okay? And if you look at privately released data, it's actually been soft but stable. Okay, soft but stable. So it surprised me that the market was so confident that we would have cuts in both November and December, or I think it was the last day of October that we got the FOMC announcement, around the 29th or 30th, I think it was, so towards the end of the month. But it was priced in 100% chance of a cut in both November and December. Very, very surprising to me, given the market, okay, it's softening, but it's very stable. Okay, and I think that what you've seen now, and why we've had a little bit of a correction last week, especially after the Fed, is because the market has realized this, okay, that it probably overstepped the mark. Jerome Powell has come out and said a few things to that effect as well, which is what has caused, I think, some of the sell-off last week. Okay, so I don't expect that to continue into this week, I'll be honest with you, because I think the market has corrected. We've now got something like a 60% chance of a cut in December, which is down from 80 to almost 100% at points. So I think the market's made enough of a correction there. So I believe we're now done with the correction, essentially. Now, one final thing really, really important to look at is earnings, ultimately probably the number one factor, okay, driving the market, because the market's made up of companies, and if companies aren't earning money, well, they're in trouble. One thing is interesting, right, is over the last few years we can see this, that the top companies, you know, like the Googles, the Facebooks, or Meta or Alphabet, or whatever you want to call the parent companies, these companies are really starting to make up a larger part of the S&P 500. And I think that's a good thing in terms of for us to be able to analyze the market, because we can now focus our efforts on just a few companies and see what is earnings growth like. Okay, now what I can say is in the last kind of quarter, you can see here, the earnings growth of these top companies is very, very strong, okay, and it continues to be forecast to be strong. So I said I'd keep this very short. Earnings suggest that this market is very well supported, okay? So I don't buy into the fact that there is an AI bubble at the moment. Several factors for that. Number one, they're essentially tech companies, aren't they? They're tech companies. They are very diversified in what they're doing compared to previous bubbles that we've had, you know, like in the 2000s, it was very telecom focused, whereas the tech companies are very, very diversified. They've got a good range of product offerings, and their revenue is sourced from many, many different angles these days. So much better diversified. Number two, investment in AI is predominantly done from internal cash flow, so actual cash that these companies have generated and have in the bank. So no debt, essentially, like what we saw in the last big bubble, I suppose, 2000s. That was all debt, wasn't it? It was debt-driven investments, highly leveraged. Now it's all cash, basically. They're spending cash. So ultimately, if they lose, well, they've lost cash, right? They're not going to collapse because it's not debt on the balance sheet. So very, very low leverage investment in AI. Nonetheless, high in absolute amounts, but low leverage. Okay, very, very important key distinction. Number three is, we just talked about it, the Fed remains quite accommodative in the sense that they are cutting rates, so obviously very, very supportive in terms of support towards the economy, in terms of interest rates, so we've talked about that already. And then number four, valuations as well, okay, which is the final thing we're going to talk about. If you look at the valuations of some of these telecoms companies that I talked about, like in the 2000s, crazy valuations, earnings not keeping up with the rally in price, which meant that, you know, you're getting crazy multiples, 130 times price earnings ratios, absolutely insane. So, you know, as soon as things start going wrong, it's only going to go one way, right? Whereas here you look at the price of things like Nvidia, earnings are keeping up. They're actually backing up their price with earnings, which means their price earnings ratios are very, very stable. Okay, very, very important factors. And that's why I said this is, you know, I know it's not an exciting video because we're not looking at some of the silly things people are looking at, but this is what's driving the market, okay? And this is what's keeping it very well supported, okay? So in terms of the week ahead, and then we're done, I have got my own calendar. I think it's important that you do this. We look at where we are today. There's actually nothing, okay, in the week ahead. Nothing at all. CPI, that probably won't be released because of the government shutdown. There might be some private data, but really, really nothing. Some even retail sales, I believe, won't be released. So nothing really of note. Maybe some private jobs data, but I just don't think that there's going to be anything the market's going to look at. And it's a bank holiday. Therefore, I think the status quo will continue. Okay, what is the status quo? Well, we've already said the Fed remains very accommodative, right? So nothing really changing on that front, although I would keep an eye on, like I said, inflation is a big one to keep an eye on. The market has corrected, okay, in terms of expectations. I encourage you to look at this. Anyone can find it, okay? Look, you can see here. It's online, it's available. You can see here, it's the likelihood that the Fed will change the target rate at the upcoming FOMC meeting, which is in 31 days, okay? So quite a bit of a way out still. So we're talking 10th of December, okay? And we're now Sunday the 9th of November. So we got almost a month, right? Or a little over a month. And you can see here, a month ago, 81% chance of a rate cut at that December meeting. It actually went up almost to 100% over the last 4 weeks. We're now down at 66%. You can see that here, current 66%. Remember earlier in the video I said 60%, so 66%, which I think is a good correction. That's my point. We've gone from 100% forecast, market forecasting a 100% chance of a rate cut, down to 66. So I think the correction is done, if I'm honest with you. That's enough of a correction over here, okay, which I think was the main factor, correcting the market. And that's why I think we'll be pretty well supported going forward. Number two, so number one is Fed funds forecast has corrected enough to take into account the fact that, like I said, jobs is probably not as soft as people were saying it is. It's actually quite stable. It's softened, but it's starting to stable. Inflation still, it's a bit toppy, isn't it? Around the 3%. So probably the market was overdoing it, okay, in terms of expecting a 100% chance of a cut. So that's been corrected, number one. And then number two, zero data. Okay, so really, what is there next week to cause the market to have much of a panic reaction? The only caveat to all of this, okay, of course you've always got to expect that what you predict doesn't happen, is that a major player offloads a huge amount of stock and we suddenly see a chain reaction. Okay, I don't expect that to happen, but obviously never say never. But I've put my foot out there, you know, I've put my neck, I should say, on the line, and so I think the market will stabilize next week, and we'll continue to see some of this stability, especially with the lack of data. Okay, so hopefully that was useful for you. See you later.